Ladies and gentlemen, here, I want you to look at your watch. Last night, while New York was sleeping, while London was just pouring its morning coffee, and while the algorithms that run the global financial system were in low power mode, something happened in Tokyo that should not be mathematically possible. We are told that the US Treasury market is the risk-free asset. We are told it is the deepest, most liquid, most pristine ocean of capital on planet Earth. We are told that you can sell $1 billion of US debt in a millisecond and the market won't even blink. That is the lie that holds the Western world together. Last night, at exactly a.m. Eastern Standard Time, that lie was exposed. A sell order hit the computerized ledger of the US Treasury market. It wasn't a stand of rebalancing. It wasn't a hedge fund taking profit on a quarterly trade. It wasn't a fat finger error despite what Bloomberg is frantically trying to tell you this morning. It was a block trade of $50 billion in 10-year US notes. And for precisely 11 seconds, there were zero buyers. The screen went black. The bid disappeared. The algorithms that are programmed to buy the dip simply turned off. For 11 seconds, the value of the global reserve asset was effectively undefined. Now, you might be thinking, it's just 11 seconds. The market recovered. Why does this matter? It matters because in the world of high-frequency trading, 11 seconds is an eternity. It is the difference between a glitch and a cardiac arrest. If you were a human trader sitting at a desk in Singapore or Hong Kong last night, you saw something that you're never supposed to see. You saw the bid stack, the wall of buy orders that protects the US dollar, evaporate. You saw an air pocket, and when the price finally reappeared 11 seconds later, the yield on the 10-year Treasury had spiked by 14 basis points in a single tick. That is a 4 standard deviation event. It is a black swan happening on a Tuesday. The mainstream media is already spinning the narrative. They are calling it a liquidity hiccup. They are blaming it on a software update. They are telling you that order has been restored. They are lying. What you witnessed last night wasn't a glitch. It was a rejection. It was the moment the United States lost its buyer of last resort. Because we know who pushed the button. We have looked at the custodial flows. We have tracked the movement of the collateral from the foreign official accounts at the New York Fed. The seller wasn't a bank. The seller wasn't a chaotic emerging market. The seller was Japan. And that changes everything. To understand why a $50 billion sale from Tokyo is the beginning of the end for the current financial order, we have to do some history. We have to go back to the grand bargain that was struck in the ashes of World War II and solidified in the 1980s. For 40 years, Japan has been the loyal vassal of the American financial empire. It is a harsh term, but it is the forensic reality. When the United States runs a deficit, when we spend money we don't have on wars, on welfare, on bailouts, we issue debt. We print treasury bonds. Someone has to buy those bonds. For decades, Japan has been the reliable buyer. They run a trade surplus. They sell us Toyotas and PlayStations. They get dollars in return. They dutifully recycle those dollars back into U.S. debt. They hold $1.1 trillion of our paper. They are the largest foreign holder of U.S. debt in the world, larger than China, larger than the U.K. They are the anchor. When the rest of the world gets scared and sells, Japan holds. When the U.S. needs to lower interest rates, Japan buys. They have absorbed our inflation. They have financed our wars. They have suppressed their own currency to keep the U.S. dollar strong and the American consumer happy. But last night, the vassal rebelled. They didn't just sell bonds. They initiated a collateral substitution. They looked at their balance sheet. They looked at the collapsing yen. They looked at the soaring cost of energy imports. And they made a cold, calculated decision. They decided that saving the Japanese yen was more important than saving the U.S. Treasury market. This is the shatter point we have been warning you about on this channel for 6 months. We told you that eventually the pain would become too great. We told you that self-preservation always overrides alliance. Last night at a.m., the Bank of Japan effectively told the Federal Reserve, "We are full. We are not buying any more. In fact, we are selling." Let's go deeper into the forensics of the trade itself. Because the timing is the smoking gun. Why a.m.? In the financial world, liquidity is like the tide. It comes in and it goes out. At a.m. New York time, the tide is at its lowest. The U.S. banks are closed. The London banks are just waking up. The depth of the market is thin. If you are a friendly ally, if you are trying to help the US, you do not sell at AM. You sell at AM when the market is full of buyers who can absorb the blow. Selling at AM is a hostile act. It is designed to inflict maximum damage. It is designed to smash the price down as hard and as fast as possible. It is a message. Japan is signaling that they are desperate. The yen has been trading at historic lows, touching 160, then 165, then threatening 175, then threatening 170 against the dollar. At 170, the Japanese economy breaks. Energy prices in Tokyo double. Food prices skyrocket. The ruling party faces political annihilation. The Bank of Japan had to intervene. They had to buy yen to prop it up. But to buy yen, you have to sell dollars. And the only place Japan has $1 trillion sitting around is in US treasuries. So they sold. They dumped a block of $50 billion into the thinnest market of the day, fully knowing it would cause a flash crash. They sacrificed the American bond market to save their own currency. And here is the terrifying part. It worked. For a few hours, the yen strengthened. The bleeding in Tokyo stopped. But the bleeding in the global financial system has just begun. Because that 11-second freeze wasn't just a technical glitch. It was the sound of systemic trust evaporating. Think about the implications. If Japan, the safest, most loyal, most aligned holder of US debt, is dumping $50 billion blocks in the middle of the night, who is safe? What happens when China sees this? China holds $700 billion. If they see Japan exiting the burning theater, do they sit in their seats or do they rush for the exit? What happens when the hedge funds see this? We are looking at a potential cascade of liquidation. The no-bid event proved that there are no buyers at these prices. The Federal Reserve is currently doing quantitative tightening. They are selling bonds, not buying. Their commercial banks are full, so if Japan sells, who buys? No one. That is why the yield spiked. That is why the heart monitor flatlined. We are staring at the edge of a liquidity cliff, and the timing could not be worse. Remember the debt wall we discussed in the 40% lock dossier? The US Treasury needs to refinance $9 trillion of debt in the next 12 months. They need to sell $9 trillion of bonds just to pay off the old ones. They need buyers. They need Japan. They need the loyal vassal to show up at the auction and write the check. But last night, the vassal just threw the checkbook in the trash. If Japan turns from a net buyer into a net seller, the supply of US bonds overwhelms the demand. Economics 101. When supply exceeds demand, price crashes. When bond prices crashes, bond prices crash, yields explode. We're not talking about yields going from 4.5% to 4.6%. We're talking about a repricing of the entire world. If the 10-year Treasury goes to 6% or 7% because Japan walks away, the US housing market freezes, the US banking system, which is loaded with these bonds, faces insolvency. This is the doom loop, and Japan just kicked the first domino. But there is something else, something darker. As I analyzed the data from last night, I noticed a secondary anomaly. The $50 billion sell order was the headline. It was the explosion that everyone heard. But in the chaos of that explosion, while the algos were frozen and the traders were panicking, another mechanism was quietly triggered in the background. It is a mechanism that connects the yen, the dollar, and the stock market in a deadly triangle. Most people think this event starts and ends with bonds. They think, okay, Japan sold bonds, yields go up, bad for real estate. That is level 1 thinking. But looks at level 2. We look at the derivatives. We look at the leverage. Hidden inside the plumbing of the Tokyo-New York channel is a trade that has been building up for 20 years. It is the biggest, most crowded, most dangerous trade in financial history. It is called the carry trade. And last night when Japan defended the yen, they didn't just sell bonds. They accidentally tripped the wire on a financial guillotine that is hanging over the neck of Wall Street. We saw the first twitch of that guillotine at AM. While the Treasury market was freezing, the S&P 500 futures suddenly dropped 40 points in a vacuum. Why? Why would a bond sale in Tokyo crash a stock index in Chicago? Because they are connected by the yen carry. If my analysis is correct, the $50 billion dump wasn't the end of the crisis. It was the margin call that starts the liquidation of everything. We're not just looking at a bond tantrum. We are looking at a global margin call. You are wondering why your tech stocks are jittery this morning. You're wondering why Bitcoin took a sudden dive at AM. It all traces back to the carry. We are going to open the hood of this machine. I'm going to explain exactly what the carry trade guillotine is. I'm going to show you how free money from Japan was used to inflate the US AI bubble and what happens when that money isn't free anymore. The 11-second freeze was the warning. The guillotine is the execution. We established the crime scene. Japan dumped $50 billion of US treasuries at AMM, causing an 11-second cardiac arrest in the bond market. But a crime scene is just a snapshot. To understand the motive and, more importantly, the consequence, we have to understand the weapon. You might be sitting there thinking, okay, Japan sold some bonds. My portfolio is mostly tech stocks and crypto. Why should I care about the Japanese yen? You should care because your portfolio is likely funded by the Japanese yen. You just don't know it. The mechanism we are uncovering today is what I call the carry trade guillotine. It is the invisible plumbing that has pumped up the price of Nvidia, the price of Bitcoin, and the price of Manhattan real estate for the last 24 months. And last night, the Bank of Japan just cut the pipe. To understand this, we have to look at what Wall Street has actually been doing since 2024. They found a glitch in the matrix. They found an infinite money cheat code. Here's how the trade works. It is deceptively simple, but fatally dangerous. Step 1. A hedge fund manager in New York calls a bank in Tokyo. He asks to borrow 10 billion yen. Why yen? Because for years, the interest rate in Japan was effectively zero. It was free money. The Bank of Japan was practically giving it away to stimulate their dying economy. Step 2. The hedge fund manager takes that 10 billion yen and instantly sells it to buy US dollars. Pay attention to this. Selling yen suppresses the yen. Buying dollars boosts the dollar. This keeps the vassal relationship intact. Step 3. Now holding dollars, the manager buys US assets. He buys US Treasury bonds paying 5%. He buys AI stocks like Microsoft or Palantir. He buys high-yield corporate debt. Step 4. The profit. He owes Tokyo 0%. He earns 5% or 20% if he's in stocks in New York. He pockets the difference. It is pure risk-free arbitrage. This is the yen carry trade. It sounds like a perfect machine, and for years it was. Estimates suggest there is over $20 trillion of this carry leverage floating around the global system. The entire AI bubble of 2025 wasn't just built on GPU demand. It was built on cheap yen. But every machine has a kill switch. The carry trade only works under 2 conditions. 1. Japanese interest rates stay low. 2. The yen stays weak. If the yen gets strong, the math breaks. The machine explodes. And that brings us back to last night at AM. When Japan dumped that $50 billion in US treasuries to defend the yen, they triggered a massive short squeeze on their own currency. The yen spiked up. Now imagine you are that hedge fund manager. You borrowed 10 billion yen when the exchange rate was 160 yen to the dollar. That loan cost you about 62 million US to pay back. But suddenly, because of Japan's intervention, the yen strengthens to 140. Now that same 10 billion yen loan costs you $71 million to pay back. You haven't done anything wrong. You own the same stocks, but overnight your debt just increased by $9 million. Your profit is gone. You are underwater. And then the phone rings. It's the risk desk. It's the margin call. They tell you the yen is moving against us. Close the position. Pay back the loan. Now, this is the guillotine. To pay back the yen loan, you have to get cash fast. Where's your cash? It's tied up in US assets. So, what do? You sell the US treasuries. You sell the Nvidia stock. You sell the Bitcoin. You don't sell because you want to. You sell because you have to. You are a forced seller. And this creates the liquidation loop. 1. Japan sells bonds to save yen. 2. Yen gets stronger. Free. Hedge funds get margin called. 4. Hedge funds sell more bonds and stocks to pay back the yen. 5. Bond yields spike higher. Stock prices crash. 6. Panic sets in. Japan sells more bonds to stabilize the chaos. Repeat until the system breaks. This is why the S&P 500 futures dropped in sync with the bond dump last night. It wasn't sentiment. It was mathematical liquidation. The free money spigot just turned off. And here is the terrifying part that the financial media is ignoring. They are treating this $50 billion dump as a one-off event. They think Japan did it once, made their point, and will go back to sleep. Forensic analysis suggests otherwise. We are tracking the implied volatility in the Japanese options market. It is screaming. The traders in Tokyo are pricing in more rate hikes and more bond sales. Japan is trapped. If they stop selling U.S. treasuries, the yen crashes to 200 and their country enters hyperinflation. If they keep selling U.S. treasuries, they crash the American financial system and trigger the guillotine. They have chosen their path. They are choosing survival, which means the carry trade is unwinding. All $20 trillion of it. Think of it like a crowded nightclub. The music has been playing for 10 years. The alcohol has been free. Everyone is dancing. The club is packed beyond capacity. Japan just turned on the lights and yelled fire, and there's only one exit door, the U.S. Treasury market. But wait, if everyone is rushing to the exit, if everyone is trying to sell U.S. treasuries to pay back their yen loans, who is on the other side of the trade? Who has the cash and the stupidity to buy trillions of dollars of U.S. debt while the largest holder, Japan, is dumping it? The Federal Reserve is doing quantitative tightening. The commercial banks are tapped out. This leads us to the vacuum. We're approaching a moment where the sellers outnumber the buyers by a ratio of 100 to 1. And when that happens, the price of the bond doesn't just go down, it goes to no bid. We saw it for 11 seconds last night. I'm going to show you what happens when that 11 seconds becomes 11 days. I'm going to explain the debt wall that is approaching in March 2026 and why the U.S. government is about to face a funding crisis that will make 2008 look like a picnic. Japan just walked away from the auction. The question is, can the U.S. survive without them? We watched the loyal vassal, Japan, rebel and dump $50 billion in bonds. We watched the carry trade guillotine slice through the hedge funds. But if you think this story is about a few over-leveraged traders in Connecticut losing their Ferraris, you're missing the scale of the disaster. The hedge funds are just the appetizers. The United States government is the main course. We need to talk about the debt wall. If you have been following the dossiers, you know we circled March 2026 on the calendar months ago. We told you it was the window of vulnerability. Why? Because debt has a life cycle. It is born, it pays interest, and then it dies, matures. When it dies, you have to pay back the principal. Unless, of course, you are the United States. You don't pay back principal, you just borrow more money to pay off the old money. You roll over the debt. It is a Ponzi scheme that only works as long as there are new investors willing to buy the new paper. And that brings us to the nightmare math of 2026. During the COVID crisis and the inflation spikes of 2024, the U.S. Treasury did something incredibly short-sighted. To save money on interest payments, they issued trillions of dollars in short-term debt, T-bills, and 2-year notes. They acted like a subprime borrower taking out an adjustable-rate mortgage because the teaser rate was low. Well, the teaser rate just expired, and in the next 60 days, specifically peaking in March, a massive wave of that short-term debt matures. We're talking about roughly $9 trillion of U.S. debt that must be refinanced in the next 12 months. The U.S. Treasury has to go into the market and sell $9 trillion of bonds just to stay solvent. They are not raising cash for new roads or hospitals. They are raising cash just to keep the lights on at the White House. Now, imagine you are Janet Yellen. You are standing in front of that $9 trillion debt wall. You need to sell. You must sell. You look out into the audience of buyers. Usually sitting in the front row holding a massive checkbook is Japan. Sitting next to them is the Fed printing money. Sitting next to them are the U.S. banks. But today, the seats are empty. The Fed is doing quantitative tightening, selling. The banks are insolvent and full of bad commercial real estate loans. And Japan just stood up, flipped the table, and walked out of the room. This is the funding cliff. When you have $9 trillion of supply and zero strategic demand, price discovery becomes violent. We saw yields hit 4.5% last week. Without Japan, the natural rate for the U.S. 10-year Treasury isn't 4.5%. It is 6%, maybe 7%. You might say, so what? Rates go up? Who cares? The math cares. Let me explain the concept of fiscal heart attack. The United States currently generates about $4.9 trillion in tax revenue. Before this crisis, we were spending about $1.1 trillion a year just on interest on the debt. That's more than the entire defense budget. That's more than Medicare. But that $1.1 trillion interest bill was calculated at an average interest rate of around 3%. If Japan leaves and rates reprice to 6%, the interest bill doesn't just go up a little, it doubles. If the US government has to pay $2.2 trillion in interest, that is 45% of all tax revenue. Think about that. Nearly half of every dollar you pay in taxes would go solely to paying interest to bondholders. There is no money left for the army, no money for Social Security, no money for government salaries. This is called fiscal dominance. It is the mathematical point where currency dies. The bond market knows this. The bond vigilantes smell blood. They know that US cannot afford 7% interest. They know the system breaks at 5.5%. So what happens next? We enter the no-win scenario. The Federal Reserve has two choices. Both lead to disaster. Choice A, the hard default. They let rates rise to 7%. The US government enters a chaotic austerity spiral. They slash spending. They default on social promises. The economy collapses into a Great Depression-style deflation. The politicians will never allow this. It is political suicide. Choice B, the soft default, yield curve control. This is the path of least resistance. The Fed sees the no-bid auction. They see Japan leaving. They see the rates spiking to 7% and they panic. They announce, "We will buy the bonds. We will be the buyer of last resort." They fire up the printer. They print trillions of dollars to buy the unsold debt. They artificially pin the interest rate at 4.5%. This saves the government, but it murders the dollar. If the Fed prints $9 trillion to absorb the debt wall, inflation doesn't go to 3%. It goes to 15%. It goes to 20%. We are talking about 1970s-style stagflation, but on steroids. We're talking about the lirification of the US dollar. Japan knows this. Why do you think they are selling now? They are front-running choice B. They know the US has to print. They know the dollar is about to be diluted into oblivion to save the treasury, so they are dumping their dollars before the printing press starts. They are exchanging a depreciating asset, US debt, for a hard asset, gold, commodities, domestic infrastructure. The rejection we saw last night wasn't just about saving the yen. It was a vote of no confidence in the solvency of the United States. Japan has seen the debt wall. They have done the math, and they have realized that the US Treasury is a subprime borrower wearing a Gucci suit. So where does this leave us? We are trapped in a burning building. The fire exit Japan is locked. The sprinkler system the Fed is filled with gasoline inflation. And the debt wall is falling on us in less than 60 days. The markets are currently in denial. The stock market is hoping for a Fed pivot. They think a rate cut will save them. They don't understand that a rate cut caused by a failed auction isn't a stimulus, it's a panic signal. It's the signal that the sovereign itself is distressed. When the sovereign breaks, everything priced in that sovereign's currency breaks too. This is the end of the 60-40 portfolio. This is the end of the 60-40 portfolio. This is the end of passive investing. You cannot hold the debt of a bankrupt nation as your safe haven. So if the bonds are toxic and the cash is about to be debased and the stocks are about to be liquidated by the carry trade, where do you hide? Is there an asset that has no counterparty risk? Is there an asset that acts as the lifeboat when the treasury ship sinks? Japan is buying it. China is buying it. The central banks are hoarding it. But the average American investor has 0% exposure to it. I am not just going to tell you buy gold. You need more than that. You need a specific structure. You need to know how to position yourself for the yield curve control pivot. I am going to give you the 3 assets that historically survive a sovereign debt crisis, and I'm going to give you the Japanese hedge. A specific trade you can make right now to profit from the chaos in Tokyo. The wall is falling. Time to move out of the blast zone. We have spent the last 15 minutes dissecting the crime scene. We watched Japan dump $50 billion in treasuries, triggering a no-bid heart attack. We watched the carry trade guillotine slice through the neck of the AI bubble. And we stared up at the $9 trillion debt wall that is about to crush the U.S. Treasury in March. The diagnosis is clear. The risk-free rate is no longer risk-free. The loyal vassal has left the building, and the United States is entering a sovereign debt spiral. So the time for analysis is over. The time for positioning is now. Most of you are sitting in what financial advisors call the 60-40 portfolio. 60% stocks, 40% bonds. This portfolio was designed for a world where bonds protect you when stocks fall. But in 2026, bonds are not the shield. Bonds are the sword. They are the asset class that is causing the crisis. If you hold a 30-year U.S. Treasury bond today, you are not an investor. You are a bag holder. You are locking your capital into a currency that is about to be debased at an interest rate that is mathematically insolvent. You need a new playbook. You need a war portfolio. Here are the 3 protocols you must execute to survive the T-bond rejection. Protocol 1. The duration purge. Cash is king, but only for a moment. The first rule of a sovereign debt crisis is don't trust the promise. When you buy a 10-year or 30-year bond, you are trusting the U.S. government to pay you back in 2036 or 2056 with dollars that have value. That is a bad bet. When Japan sells, yields on long-term debt explode. The price of the bond crashes. If you own a bond fund like TLT, you could lose 20% or 30% of your principal in weeks. It is dead money. Move. You must shorten your duration. Get out of the long end of the curve. Move your cash into 3-month T-bills or overnight money markets. Why? Because short-term debt matures quickly. You get your cash back in 90 days. You stay liquid. You can roll it over at higher rates as the crisis worsens. But more importantly, you are not locked in while the building burns. You're standing by the exit door, cash in hand, ready to deploy into real assets when the panic hits. In a liquidity crisis, liquidity is the ultimate option value. Do not trap it in a 30-year contract. Protocol 2, the hard hedge, the anti-dollar triad. Once you have secured your liquidity, you must deploy it into assets that have no counterparty risk. The U.S. government has 2 choices, default or print. They will choose print. They will choose yield curve control. When the Fed prints $9 trillion to save the bond market, the dollar loses purchasing power. You need assets that cannot be printed. Asset A, physical gold. We covered this in the 161-ton seizure dossier. Gold is the only asset that central banks like China and Russia are buying to replace treasuries. It is the final collateral. When the bond market freezes, gold becomes the only liquid market. It is your insurance policy against the currency itself failing. Asset B, the digital lifeboat, Bitcoin. I know some of you are skeptics, but look at the flows. When the carry trade unwinds, speculative assets crash initially. Bitcoin might dip, but watch the rebound. Bitcoin is the only asset that operates outside the banking ledger. It has no CEO. It has no yield curve. In a world where the banking system is frozen by insolvent bonds, a peer-to-peer bearer asset becomes the flight to safety for the digital generation. Asset C, fixed-rate debt, real estate. This is the inflation arbitrage. If you have a 30-year fixed mortgage at 3% or 4%, do not pay it off. That debt is an asset. As inflation rips to 10% or 15%, the real value of your debt shrinks. The bank is subsidizing your house. In a sovereign debt crisis, being a debtor with fixed rates is better than being a creditor. Let inflation pay off your mortgage for you. Protocol 3. The yen pincer, the speculative attack. Finally, for the traders in the room, there's an opportunity to profit directly from Japan's move. We established that Japan is strengthening the yen to save the country. A strong yen is great for Japanese consumers, but it is fatal for Japanese corporations. Companies like Toyota, Sony, and Honda make their money selling goods to Americans in dollars. When the yen is weak, 160, they make record profits. When the yen gets strong, 130 or 120, their profits vanish. As the carry trade unwinds and the yen strengthens, the Japanese stock market, the Nikkei 225, tends to crash. It is an inverse correlation. If you believe Japan will continue to sell treasuries to defend the yen, then you are effectively bearish on Japanese exporters. This is the pincer move. You're betting against the carry trade structure that held the world together while everyone else is crying about the unwind. You're positioned for the correction. We are entering a period of history that will be written about in textbooks for the next century. The era of Pax Americana. The era where the US dollar was the unquestioned king and US debt was the risk-free foundation of the world ended last night at a.m. It didn't end with a bang. It ended with an 11-second silence. It ended with a no bid. The market is trying to pretend it didn't happen. They are trying to patch the hole with swap lines and media spin. Do not be distracted. The debt wall is 60 days away. The loyal vassal has defected. The machine is broken. You have a choice. You can stay in the burning theater hoping the Fed comes to save you one more time. Or you can find the exit. You can move to the sidelines. Short duration. You can build your lifeboat, gold or Bitcoin. You can prepare for the repricing of the world. Don't be the person asking what happened when the bank holiday is announced. Be the person who saw the signal in the noise. Tupancha showed you their hand. Make sure you play yours correctly. This is it. The bond market is closed. Class dismissed.